Today we are tackling the absolute classic, A Random Walk Down Wall Street.
A must-read.
And look, my ego is a little bruised, but I'm ready to listen. If the experts are wrong and the monkey is right, what are we actually supposed to do with our money? That is the multi-trillion-dollar question, isn't it? Our mission today is to, strip away all the Wall Street marketing.
Okay.
We're going to look at why you mathematically just cannot time the market. We're going to explore the madness of financial bubbles. I mean, really get into the mechanics of why they happen.
And then hopefully find a way to invest that doesn't rely on luck or crystal balls.
Exactly.
So let's start with the title, because it frames everything. A Random Walk. To me, that sounds like a nice Sunday stroll, but in probability theory, that means something very specific.
It does. And understanding this is, it's crucial. In this context, a random walk describes a pattern where the next step is completely unpredictable based on the last one.
So if a stock goes up on Monday and up again on Tuesday, that tells me absolutely nothing about what it will do on Wednesday.
Absolutely nothing. There's no momentum in the way our brains want there to be.
Yeah.
Malkiel uses this brilliant analogy. He says, imagine you're standing at a busy city intersection at a red light.
Okay, I'm there.
And you have to bet your life savings on which car will inch forward first.
Right. I see a sports car, a taxi, a big delivery truck. I'd probably bet on the sports car. It's faster.
Yeah. That's the logical bet. But maybe the sports car driver is checking his phone. Maybe the taxi driver is aggressive and just jumps the gun.
Or the truck driver is asleep.
Exactly. The individual second-by-second movements are totally chaotic. They depend on things you just can't see. That's the daily stock market.
Just noise.
Just noise. But, and this is the key, you can predict that between 5 and 6 p.m., the vast majority of that traffic is flowing out of the city.
So the random walk is about the microscopic wiggles, the day-to-day noise. But the big trend, the flow of traffic, that part is predictable.
Precisely. The traffic flows out because people go home. The stock market over the long term trends up because the economy grows. The mistake is thinking you can predict the lane changes instead of just riding with the flow.
Okay, that makes so much sense. But if we can't predict the lane changes, how do we value these companies at all? Malkiel lays out two main theories of valuation, and they seem to be at war with each other.
Oh, they are. Philosophically, they're total opposites. The first one is the firm foundation theory.
This is the spreadsheet crowd. Show me the numbers.
Yes, exactly. The dud in the room. It argues every single asset, a stock, a house, it has a true intrinsic value, a firm foundation based on hard data.
And there's an actual formula for this.
There's a calculus. He breaks it down into 4 key things. Number 1, expected growth rate.
Okay, that's simple enough. A company growing at 20% a year is worth more than one growing at 2%.
Right, compound interest.
Yeah.
Number 2 is expected dividend payouts. This is just cash in your pocket.
Can't argue with that.
Number 3 is risk. We're all basically risk averse, so we'll pay more for a safe asset than a risky one.
And the fourth one, this is the one I think people always forget.
Market interest rates. This is so important.
Okay, walk me through that. Why does the Federal Reserve changing interest rates change what my Google stock is worth?
Think of interest rates like gravity for stock prices. When rates are high, you can get, say, 5% guaranteed from a safe government bond.
Right, zero risk.
So why would you buy a risky stock that you only hope will give you 6%? So when rates go up, stocks look less attractive and their value gets pulled down. When rates are near zero, stocks can fly because there's nowhere else for money to go.
Okay, so under this firm foundation theory, my job is to be a mathematician. I calculate this true value, and if the stock price is lower, I buy.
That's the idea. But then
Yeah.
there's the other theory, the castle in the air theory.
I love that name. It sounds so poetic, but in finance, that usually means you're about to get into trouble.
You are about to lose your shirt, yeah. This theory, popularized by the economist John Maynard Keynes, says it doesn't matter what a thing is intrinsically worth.
Oh, what does matter?
What someone else is willing to pay for it, period.
So this is 100% psychological. It's not about the business. It's about what the crowd is thinking.
It's the greater fool game. I might pay $1,000 for a pet rock, which is foolish. But if I think I could find a greater fool to pay $1,100 mother,
Yeah.
that I'm actually being smart.
You're building a beautiful castle in the sky, an illusion of value, and just hoping someone else buys it from you.
Exactly. Firm foundation is calculus. Castle in the air is about stories, optimism, math psychology.
And Malkiel's point is that while we all pretend to be firm foundation investors,
History shows we are addicted to building castles in the air.
the history section of this book is just It's wild. Let's start with the tulip bulb craze in Holland.
The classic bubble. But the scale of it is hard to comprehend. We're not just talking expensive tulips. We're talking a single bulb selling for the price of a mansion.
But why? I mean, did people think it was magic?
No, they knew it was a flower. But they stopped caring about the flower and started caring about the price movement. People were buying bulbs only to sell them to the next guy.
And Malkiel points out that they introduced something that was like pouring gasoline on the fire.
Leverage. They created call options, which let people bet on the future price of tulips for just a tiny fraction of the cost up front.
So you could control a huge amount of tulips with very little cash down.
Which magnifies the mania. And since it had zero firm foundation, I mean, it's a flower, it dies. The crash was just total.
And then a century later, we get the South Sea bubble in England, which is maybe even more insane.
It's more insane because the company didn't even really do anything. The pitch was, we have exclusive rights to trade in the South Seas.
But those trade routes didn't really exist, did they?
No. Spain controlled the ports and was at war with England. It was a complete fantasy. But the company directors, they were masters of hype. They bribed politicians. They started rumors.
They were building a massive castle in the air.
A massive one. The stock went crazy. Even Isaac Newton, literally one of the smartest people who ever lived, lost a fortune.
Wow.
He famously said, I can calculate the motions of heavenly bodies, but not the madness of people.
That's actually kind of comforting. If Newton can get swept up, I don't feel so bad. But this pattern just keeps repeating, right? The Roaring 20s.
The 20s gave us the blueprint for the modern crash. You have a new technology, radio, cars.
The grain of truth.
Then you have easy credit. And finally, the psychology. People convince themselves this time is different.
The four most dangerous words in finance.
Precisely. But what's really striking is that Malkiel shows this didn't stop in 1929. The 1960s had the tronics boom.
Oh, this part was hilarious.
It's just like the dot-com bubble. In the 60s, if a company just added tronics to its name, the stock would skyrocket.
Even if they, sold shoes?
He gives an example of a company that sold bagpipes door to door. They changed their name to Space Tone.
You can't be serious.
Stock went through the roof. It's the castle in the air effect. If the story is good, the math doesn't matter. Until it does.
But then you get the Nifty 50 in the 70s, which is a different kind of lesson because these were good companies.
Right. These weren't bagpipe companies. This was IBM, McDonald's, Xerox, blue chip stocks.
So they had a firm foundation.
They did. But investors got so scared of junk that they all crowded into these safe stocks, and they bid the prices up to 80 or 90 times their earnings.
Let's just pause on that. A price to earnings ratio of 80. That means it would take 80 years for the company to earn back what you just paid for one share.
It's an insane price. And Malkiel's point is that even a great company is a terrible investment if you pay a castle in the air price for it. Those stocks crashed, even though the companies were fine.
And then we hit the 90s, the internet boom. We all know that story. But Malkiel makes this point that I found really disturbing. By then, it wasn't amateurs moving the market anymore.
No. By the 90s, institutions, mutual funds, pension funds, banks, they were doing 90% of the trading.
So the dumb money was gone. The pros were in charge.
And the bubbles got bigger. That's his most damning point. The professionals are not immune. They get FOMO, fear of missing out, just like the rest of us. They join the irrationality because they can't afford not to.
Okay, so if the pros are still building these castles, what tools are they even using? It seems like it comes down to two camps. Technical versus fundamental analysis.
Well, two religions of Wall Street, yeah.
Let's start with the technical guys. The chartists. I see them on social media all the time. They draw all these lines on charts.
The chartists believe that all you need to know is in the chart of past prices. They look for patterns, like a head and shoulders or support levels.
And they think that can predict the future.
They do. And Malkiel just demolishes this idea. He says, look, it's a random walk. The market is efficient. If a chart pattern actually worked, computers would spot it and trade on it in nanoseconds, and the pattern would disappear.
He says it's like driving while only looking in the rearview mirror.
You're going to crash. Exactly.
Okay, so charts are basically astrology. What about fundamental analysis? This sounds more like the firm foundation theory, looking at the actual business.
It is. It's the Warren Buffett school of thought.
Yeah.
Look at earnings, management, the industry. Try to find that true intrinsic value.
But, I sense a but coming.
But it has huge problems for the average person. One, the data you're analyzing could just be wrong. Companies can, cook the books.
Garbage in, garbage out.
Two, your analysis could be wrong. You might think a new product is amazing and it flops. But three, And this is the killer. The market can stay irrational longer than you can stay solvent.
That famous Keynes quote again.
It's so true. You might be right that a stock is only worth $50, but the bubble pushes it to 150 before it crashes. You went broke being right.
So, this is starting to feel a little hopeless. If charts don't work and fundamental analysis is full of traps and the pros are crazy, are we just back to the monkey with the darts? What is someone listening supposed to do?
Well, he doesn't leave us stranded. He offers a synthesis. He says if you insist on picking individual stocks, you should follow 3 rules to at least tilt the odds in your favor.
Okay, I need the rules. Rule number 1.
Buy growth. Look for companies that can sustain above-average growth for a long, long time.
Rule 2.
Don't overpay. This is the anti-castle-in-the-air rule. No matter how good the growth is, if you pay a ridiculous price for it, you're setting yourself up for failure.
And rule 3.
The story. He admits psychology matters. A stock needs a compelling story to keep investors interested.
So, buy growth, watch the price, find a good story. But reading the book, it feels like his real advice is something else entirely.
It is. His ultimate conclusion, and this has really become the pillar of modern personal finance, is that for most of us, trying to pick individual winners is a loser's game.
Because of the random walk.
Because of the random walk. In the short term, you can't predict it. So your best strategy is to stop trying to beat it.
Which leads to the passive strategy, the index fund.
Yes. Instead of trying to find the needle in the haystack, just buy the entire haystack. Buy a broad market index fund like the S&P 500. You minimize risk, you slash your costs, and you are guaranteed to get the market's return.
It's kind of humbling, isn't it? The most sophisticated advice from a Princeton economist boils down to, stop trying so hard. You're not smarter than everyone else.
It is humbling, but the math is on his side. He shows, over and over, that passive index funds beat the vast majority of those highly paid active fund managers over any long period.
So why pay high fees to an expert who is probably going to lose to the monkey?
Exactly. Investing is for the long term. Speculating is for the short term.
If you're trying to get rich quick, you're speculating. If you're investing, you're just riding that slow upward drift of the whole economy.
You're capturing the firm foundation growth of the economy, not betting on which car moves first at the stoplight.
We have covered a huge amount of ground. From blindfolded monkeys to Dutch tulips, from space-tone bagpipes to the safety of an index fund.
And the theme through it all is humility. The market is a powerful and often a very irrational force.
So for you listening right now, here's the takeaway. The next time you're at a party and a friend leans in with a hot stock tip that's going to the moon,
just remember the Dutch tulips. Remember the Nifty 50. You are almost certainly being invited to buy a castle in the air.
Yeah.
Ask yourself, is this a firm foundation or is it just a really good story?
And here's a final thought to chew on. We said that 90% of trading is done by these huge institutions, people with supercomputers, PhDs.
The smartest people in the room.
And yet the data shows they consistently fail to beat a simple, cheap index fund.
Huh.
So if the experts can't beat the blindfolded monkey and the market is a random walk, is paying for active financial management ever actually worth it? Or is the entire industry just selling us the illusion of control in a world that's fundamentally chaotic?
That is the multi-trillion-dollar question.
Thanks for diving in with us. We'll see you next time.